Hello, everyone, and welcome to another great webinar here on CPAacademy.org. My name is Chris, and I'll be your webinar moderator for today. Our topic today is getting the most out of Opportunity Zone tax incentives, and our presenter today is Michael Kelley. If you haven't already, folks, go over to the Q&A. Let me know you can hear my voice, see us on your screens, as well as see Mike's very first slide. Also in the Q&A, we love to know where things are coming to us from planet Earth. So let me know where you are today, folks. And I am seeing folks coming in from all over: New Mexico, Canada, New Orleans, New Jersey, Philadelphia, fantastic, Washington, D.C. Hello, Melbourne. All righty, folks. Well, welcome one and welcome all. Now, this Q&A can be used in a couple of ways. If you have any questions regarding content from Michael, put them. Then if time does permit, we will address those. If you have any tech issues, put them there, folks. I will get to you guys as soon as I possibly can. Just remember, there's only one of me, and there are very many of you. One other area of housekeeping today is going to be your CPE credit. This class is worth 1 hour of CPE, and the way you will earn that is stay logged in for 50, that is 50 minutes of the allotted time, and answer 3 polling questions. Your credit will be indeed processed and will be available to you within approximately 24 hours. Also, please download the handout that Mike's made available for you. And now, folks, with no further ado, please welcome Michael Kelley.
Great. Thank you, Chris. Really appreciate it. Thanks, everyone, for attending today. I think the timing of this webinar is really good. Been a big pickup in interest in opportunity zones since the election. I think people realize that the program is highly likely to get extended and enhanced. And there's going to be a lot of momentum. I think it's going to be a big topic of discussion all the way through 2025. Some politicians are calling it the 2025, the Super Bowl of tax. So you've got the tax incentives from the Tax Cuts and Jobs Act largely running out, and you've got a whole bunch of new bills that are going to be presented. Opportunity zones are right in the middle of all of that. We actually expect a couple of opportunity zone pieces of legislation to go through an extension, and then a full new bill, which will be part of a bigger tax package if things go the way we expect, which would redesignate the opportunity zones, bring in new zones, and extend all the dates that we'll be talking about. So without further ado, I will jump into the presentation. Please definitely encourage you to ask questions. If I'm giving an example of something, would love to hear any feedback about what could make it clearer or anything that could enhance the presentation. This is the disclosure slide. What we're going to be talking about is very general in nature, so please do not take this as tax, legal, or investment advice. Key points. A lot of times you'll hear people, especially in the OZ community, talk about it as potentially the greatest tax incentive ever given by the federal government. And just the fact that it's in that conversation tells you how significant it can be. It really is a Roth-like benefit, tax-free compound growth out to 2047, another date that might get pushed out in the coming year. It's also broadly applicable, so any investor who has a capital gain can participate. Pretty much that's everyone over time. It's a big program. It's much bigger than other community development efforts. The Economic Innovation Group estimated that there were $6 trillion worth of capital gains, counting both realized and unrealized, back a couple of years ago when this bill came out. And that number is probably larger at this point. The Treasury originally thought $100 billion would be brought in through this program, and it's coming up on double that, and there's still a little more than 2 years left in the original plan. So it's been even more successful at attracting capital than they thought. And by comparison, new market tax credits, another big community development program, is capped at $5 billion per year. So opportunity zones are absolutely an enormous community development program. So what are people saying? It's continued to be a hot topic because the incentives are significant. It's got a positive social aspect to it, investing in low-income communities. But a lot of people were thinking until the election that it might be losing steam and was going to expire. The other issue with it, which is a legitimate one, is that people have been saying, there's a lot of money going into this, but it's coming from a very few investors. So basically private equity and family offices have been doing the smart thing and investing in it. But for other people, there have been some hurdles, which we'll talk about, which have kept it being used broadly by the investment community. So these are the basics of the friction points. One is QOF knowledge. We're trying to tackle that right now with this webinar. After an hour, you're going to be well ahead of your peers, talking with even tax professionals. They've certainly heard of qualified opportunity funds and the tax incentives involved, but a lot of them do not really understand the mechanics of it. We'll go through that in this presentation. So I hope you can come away with just the basic knowledge of how it works, which is really all you need to do to operate. The other thing is poor accessibility. The way most funds are set up, it is difficult to access the benefits, and you've got to tie money up for a long time. And those are all things that are really unnecessary. And with our fund, we're trying to make it a lot easier to access these tax benefits. And the third point is that 10-year lock-in. 95% of funds have a 10-year lockup with a liquidation shortly after you achieve the 10-year hold, which is what you need to get the biggest tax benefit, the elimination. That unfortunately handcuffs most financial planning opportunities you have with qualified opportunity funds. So we'll talk about different strategies where you can employ this. Later in the presentation, I call it a Swiss Army knife, which it really can be, but you need to control your holding period. That is essential to integrating this into financial plans. And it also improves accessibility because people might not want to tie up capital for 10 years, but if they're not tied up, they might be willing to participate. So this is the basic agenda. We'll talk about qualified opportunity funds, how they work, and what the tax incentives are. We'll talk about Parkview OZ REIT. We're the only publicly traded QOF to have a stock out in the open market. It allows for easy access to the benefits. It also allows you to control your holding period, which we'll talk about. And then we'll get into what having control of your holding period gives you, which is the tax strategy. So we'll actually go through examples and how they can be implemented in everyday financial planning. And finally, we'll wrap up comparing qualified opportunity funds with 1031 exchanges. 1031s have been around for over 100 years. They have been the gold standard for deferring capital gains for decades. But things have changed quite a bit with the Tax Cuts and Jobs Act, changed the way 1031s can be used. And we'll talk about how you might want to look at the two programs, maybe choose between one or the other, and also when they might be used in unison. I'd like to give a little bit of background on how the program developed, because some of the rules can be quirky. And I think if you understand the intent, it makes a little bit more sense. It originally came out as the Investing in Opportunities Act back in 2015. It was really a Democratic bill at that point. Sean Parker was largely behind it. He was the president of Facebook. He saw that there was a lot of warehouse capital in Silicon Valley, which is capital trapped by tax liability. So he'd see founders of companies, they would eventually lose control of their companies to the private equity guys. They would leave, but they'd leave their capital at the old company because they didn't want to trigger the capital gain liability. Company didn't need it. They just had the capital frozen there. They would have loved to have gone off and done something entrepreneurial again, I'm sure, with that capital. At the same time, he was seeing neighborhoods that could really use that capital to kickstart their economies. So he set out to design a bill that would mitigate the pain of triggering that original capital gain and encourage its long-term investment in low-income communities. Tax Cuts and Jobs Act changed everything. It created qualified opportunity funds. It restricted the use of 1031s basically to commercial real estate. And it also created the qualified business income deduction, which can reduce your income taxes on pass-through income from partnerships and also dividends from REITs. This may be the most important slide in the deck. This is really fundamental, and this is where people get confused. If you can keep these things straight that I'm about to talk about, you'll be way ahead of most of your peers. There are two capital gains and there are two benefits. So there's the original capital gain, which can come from virtually any source. It could be real estate, it can be collectibles, it can be stock, whatever it is. You basically have 180 days to reinvest that into a qualified opportunity fund. That gets the deferral benefit. Right now, that benefit goes to December 31st, 2026, which isn't very long. When the bill first passed, that was 9 years away. We as I mentioned before, there's a really good chance now post-election that this gets extended out. So we'll wait to see later in the year. But right now, you'd be paying that tax on your spring of 2027 taxes. There also was a partial elimination, which has expired. You need to hold it for 5 years for a 10% elimination and 7 years for another 5%. So it would be a total elimination of 15%. That's not available right now, but it may very well come back. But for our purposes right now, the original capital gain gets the deferral, and the gain on your investment in the qualified opportunity fund, that is where once you've held that for 10 years, you can step up your cost basis 100%. So that eliminates not only capital gain liability, but the net investment income tax of 3.8%. It is a tremendous benefit, and it goes all the way out to 2047. So it is a great way to create wealth in a Roth-like way. So I hope that's clear. Two capital gains, one benefit with each, and if you keep that in mind, it'll be very helpful. So when you do the math out, if you're looking at if you achieve the 10-year hold, you're receiving about a market rate investment, call it 7-8%. The after-tax equivalent is going to be about 3% difference. So when you do the math out, 3% on that extra 3% on that growth rate works out to an extra 40% per year. And it's not just a one-year benefit. It's every year you're getting another 40%, and it's compounding. So we'll look at a compound growth chart later in the presentation, but we all know how they go. They're a tremendous way to create wealth. Everything I've been talking about is federal tax benefits with the QOF. These next two slides, I'm going to talk about state benefits, and then I'll go back to the federal. But some states mirror the federal benefits. You get the exact same benefits at the state level as you do at the federal level. Other states are completely non-compliant. Some states are sort of in the middle. This is a map from Novogradac, who is about an 800-person CPA firm based out of San Francisco. They specialize in community development. They're the leading experts in the opportunity zone space, and they're our auditor as well. But this is their map. And if you look at Massachusetts, for example, is completely non-compliant for individual taxpayers. I'm about to flip the map over to corporate taxpayers, and you'll see that Massachusetts goes from being completely non-conforming to completely conforming. So if you're a corporate taxpayer in Massachusetts, you're getting a better deal on the qualified opportunity fund. You get both the federal and the state. In Massachusetts, you would only get the federal benefit if you lived here. And with that, I think we've made it to question number 1.
Yes, indeed, folks. We have made it to question number 1, and it is on your screens at the moment, folks. Polling question 1. How would you rate your knowledge of the Opportunity Zone program? Make your choices now, folks. This poll is active for 60 seconds. And remember, folks, if you're having any issue with seeing the polls, refresh your browser immediately. Any tech issues can be resolved that way. Or if you're having any additional issues, we also recommend going to an incognito browser to kind of enhance your experience with us today. Alrighty, folks, we're going to close out polling question number 1 now. And Mike, it appears that the majority, a little over half of the attendees at 52%, are saying none. So you have a lot of students today. Back over to you.
A lot of work to do.
Yes,
Thank you, Chris. Appreciate it. So we'll get right to it. What is a qualified opportunity fund? The important thing to remember about a qualified opportunity fund is it is the mechanism that the IRS uses to track compliance. So if you make the exact same investment and follow the exact same fact pattern, but you don't use a qualified opportunity fund, it is you're not going to get the tax benefits. So it's really essential to use a QOF in the middle, and QOFs have a bunch of rules that they have to follow, which I won't go through in this webinar, but the important thing to remember is you need to work with the QOF mechanism if you're going to get opportunity zone tax incentives. What is an opportunity zone? They're based on census tracts. They're kind of like zip codes, but a little bit smaller. And basically only the census people use them. But they're typically 2,000 to about 8,000 in population. So they're whole towns out in rural areas and just neighborhoods and more urban settings. There are over 8,700 of them across the country, and they really come in all shapes and sizes. It's hard to characterize them. The bills, the goal of this is to get new capital into these low-income neighborhoods. There are two ways to qualify when you're buying real estate, which is the majority of these funds. It could be original use, which is something new, something brand new that you've built, or you can substantially improve a property. So they don't want you to just buy something that was already existing. You've got to add something, put new capital into the community, not just replace capital that's leaving. We prefer original use. We get involved with properties that are already under construction to reduce the permitting risk and to help us comply with the OZ standards, which you do have to get these things done and get the money working in a fairly rapid manner. So we like to partner with developers and get involved with new properties. So eligibility for QOFs, it's basically anyone who owes a capital gain liability to the IRS. So you can be a U.S. citizen or not, you can be living abroad or not, you can be an individual or a corporation. The big thing to remember here is that you've got a capital gain, and you basically have, we'll talk about it a little bit more, but you've got 180 days to make that investment. So a recent capital gain is what you really need. You can make capital gain money. You can put non-capital gain money into a QOF, but you wind up with, you won't get the tax benefits. So you can put in some money that qualifies and some money that doesn't. That isn't an issue, but the recent capital gain money is the money that's going to be eligible for the tax incentives. So it's basically any type of capital gain. There are a couple of exceptions, but they're really hard to find. For all intents and purposes, any capital gain that you have, whether it be from stock or from real estate, is going to qualify. It's really the time limit of 180 days. I was trying to figure out a few kind of capital gains that wouldn't work. It's basically as long as capital's at risk, it seems to be that works. There are very few examples where like carried interest is taxed as a capital gain, but you really don't have any capital at risk. It's really a form of compensation. That does not count, but anytime you've got capital at risk, you can be pretty confident that it's going to be a qualifying gain for the purposes of QOF investment. So as there, as I said, you've got 180 days to reinvest once you've had a capital gain. But when that 180 days starts is there's a lot of flexibility to that. If you're an individual and you're just trading in your brokerage account, that's going to be a straight 180 days. You have direct control over that money. But there are a lot of other circumstances where the 180 days, when it starts, you have several options. One of them is installment sales. So we were wondering when the rules were first coming out, if you've got an installment sale, say you sold a business 10 years ago, you're getting payments over the course of 10 years. The portion of that payment, which is capital gain, is that a new capital gain this year? Is that eligible for QOF investments? And it turns out in the final regs clarified that it is eligible capital. So when you can choose to start your 180-day period when you get the payment, and that portion that is considered capital gain is going to be eligible for QOF tax incentives. You can also aggregate any payments you get during the year and start your 180-day clock at December 31st, which is very convenient. If you've got, say, monthly payments coming in, you can just aggregate them all and make one investment. Another example with a lot of flexibility is partnerships. The IRS was concerned that a lot of limited partners might not even know that the partnership they're in had a capital gain. So they gave them a lot of flexibility. So first, the partnership could choose to take the capital gain and invest it in a QOF. If they choose not to and send it down to the limited partners, then the limited partners have the choice of starting their 180-day period when they get the proceeds at the fiscal year end of the fund, usually December 31st, or at the taxes due date, which is typically March 15th for a partnership. So a lot of flexibility there on when to start your 180-day period. You have to choose one of them, but any of those start dates will do. A 1231 gain, we'll talk about these a little bit later. It's 1231 is a business asset held for more than a year. It is taxed asymmetrically, so that, it's taxed asymmetrically so that gains are taxed at capital gains rates and losses are taxed at income tax rates, ordinary tax rates. So we weren't sure if they're going to make you pair if you had a gain and a loss in the same year, but you do not. You can use a 1031 capital gain, even if you've got a loss, to invest in a QOF. There's no netting needed. Also, regulated investment companies, which include mutual funds and real estate investment trusts, you get two options. It's when the capital gain is distributed or the fiscal year end of the entity. And we have made it to question, Chris.
Yes, indeed. Folks, polling question number 2 is now live on your screens, and we are asking, do you feel a qualified opportunity fund investment could be helpful for either yourself or a client? Make your choices now, folks. Active for 60. Continue making your choices on this one, folks. 20 more seconds. Alrighty, folks, and as we wind down polling question number 2, it appears that the majority of the attendees coming in at 41% are selecting option C, which is maybe.
All right. Thank you very much, Chris. So Parkview OZ REIT, we're the only, I'm going to talk about the fund a little bit and how we make it easier to operate and use these for as financial planning mechanism. We're the only QOF with publicly traded stock. The way these funds have been set up is really like traditional partnerships, and it makes sense because it's geographic based. It's a real estate works really well with it, and most real estate funds are all locked up for 4 to 7 years, and then they have a liquidation event. With this, they just extended that out from 4 to 7 years to 10 years to achieve that holding period. But we thought that we had a chance to bring a lot more benefit to investors by giving them a structure that was easy to access. And, we really looked at this from the consumer's point of view, trying to create a fund that has low fees, but still great tax advantages, great flexibility, and allows people to enjoy the same commercial real estate drivers. And commercial real estate's a really good asset class, typically outperforms the stock market over the long term. So one of my friends who's a tax attorney was talking about the issue that we set out to solve. And we were talking about this back when we were coming up with the idea for the fund. And he was saying that the problem with qualified opportunity funds, and the reason they were getting a lot of assets from a very small group of people instead of a lot of assets from a broad group of people, was what he called the AIV problem, which is stands for awkward investment vehicle. So you've got, with partnerships, these typical partnerships, the way these QOFs are set up, you wind up with K1 tax forms and potentially multiple K1 tax forms if you're in different states, which are notoriously difficult. You've got partnership minimums, which if you're trying to invest a capital gain, even if you're wealthy, you may only have a small amount of money that is a capital gain. It may be enough that's well worth deferring and taking advantage of these benefits, but you only can invest and get the benefits for what you have a recent capital gain for. Accreditation requirements, that eliminates most investors right off the top. And even if you are an accredited investor, it can be an invasive process to prove you are one. And the illiquidity, the 10-year hold with the liquidation shortly thereafter, it hurts in both cases. It makes it less accessible because a lot of people don't want to tie up capital for 10 years. And it also, as we'll talk about quite a bit later on, really hurts your flexibility for financial planning purposes. So the main friction points: improving accessibility, giving a structure with stock really helps to make it easy to get involved with this versus the traditional partnership. And the financial planning utility, really, when you have stock, you can, that's when it becomes like a Swiss Army knife, and you can use it for all sorts of financial planning reasons. This is our slightly tortured acronym, which because we have stock that's publicly traded, we can eliminate high investment minimums. You can invest through on our website. We have an electronic subscription agreement. The minimum's $10,000 investment. You can buy stock in the open market. You can just buy one share. So that really reduces the hurdle of the high investment minimum. The accreditation requirements do not apply because we went through a much more vigorous process with the SEC. The K1 tax forms are replaced by the typical tax forms you get with stock, the 1099 DIVs, and the investor controls the holding period. It's not based on what the fund manager wants. It's up to you, whatever works best for you, whatever holding period matches your financial situation best, you can take advantage of that. History repeats. This has happened before. Back in the 60s and 50s, people were making a lot of money in commercial real estate. As I said, it's a great asset class, but the average investor wasn't participating for all the reasons I just listed. So it was actually the last bill sponsored by John Kennedy before he became president, and the last bill sponsored by Eisenhower, or signed by Eisenhower before he left the presidency. And it created a real estate investment trust, which allowed people to invest in commercial real estate through a corporate structure. So they weren't liable for the debt or anything else of the partnership. It was just like owning stock, but it was taxed like a partnership. It didn't get the double taxation that corporations normally do. So that's why we're using the REIT structure. It allows us to act like a partnership, but give people the flexibility and ease of access that they need. This is a good example of an OZ investment. Townhouses at 2209 North Boulevard in Tampa Heights. We bought these with when they were a few months away from completion. It is a terrific neighborhood right next to downtown Tampa. It's just adjacent. You can see how close it is on the next slide. This on the left is Armature Works, which is a converted factory. It's now 20 bars and restaurants right on the Hillsborough River. It's visible from the townhouses, absolutely beautiful. You can see in the distance how close downtown Tampa is to Tampa Heights. And on the right is the Riverwalk, which is a great place to just take a walk, but it's the commute for you if you live in Tampa Heights and work downtown. It's a great neighborhood. You're seeing, in addition to Armature Works creating all those restaurants, there are microbreweries, restaurants popping up. And as an opportunity zone, it's attracting a lot of capital. So a lot of the lots around ours are getting fixed up as well. So this is the investment strategy. We're value driven. Due diligence has been most of my career. So looking at a lot of properties in different situations and demographics. We control project risk. We do like to come in after the permitting process and keep leverage very limited. We look at this as our investors want a good tax return, but they want to make sure we're around for the long term and that we're compliant with the opportunity zone benefits. So we make sure that we stay down the middle of the fairway on those things. And we can look at a broadly diverse geography and asset class, but the main focus is on where there's population and job growth. So that's the warm weather, low tax states typically. And there's a shortage of residential units in this country, but depending on who you talk to, 4 to 7 million units. So we're very positive on residential, and that's basically our focus. We're always looking for partnerships. We partner with developers because that allows us to borrow their expertise. They know the local governments. They know how to get the permitting done and find the locations. So we provide a source of capital for them. And on the investment advisor side, we love to create partnerships, and we try to make them look good to their clients, provide them with a lot of information that they need to provide their clients with better tax options. And it's a great source of business for us. So we're always looking to partner and exchange ideas. These next few slides are just sort of going over what the fund offers. It goes, I'll largely let you read those, but you get the deferral, of the original capital gain, the elimination after the 10-year hold anytime between now and 2047, the QBI deduction also on the dividend. The REIT is a tax efficient vehicle in itself. You get rid of the K1s and swap that out for the much easier 1099 forms. Tradable shares are really important to what we're doing. No sales commission. Keeping sales, REITs in general have lower fees than partnerships, but keeping fees low is really important. You don't want to save on tax and then give it back on fees. We're also a publicly reporting company, so all of our financials are on the SEC website, so you get much better transparency. And as I mentioned before, you get the low investment minimum of 1 share out in the open market or 10 shares or $10,000 through our electronic subscription agreement on our website. These are our service providers. I already mentioned that Nova Gradic is our auditor. They also file our taxes. STC is our stock transfer agent, and our legal opinion was done by Whiteford Taylor Preston. And I think we've made it to question number 3.
Yes, indeed, we have. Folks, polling question 3 is live on your screens now. What action steps do you plan to take as a result of this webinar? 60 seconds, folks. Make your choices now. We have a tight race for this one, Michael. Looks like. Let's see if we can get a clear-cut winner here shortly. In about 10 more seconds, folks. Thank you, folks, for getting your answers in so quickly. I'm polling question number 3. And so at 49%, the attendees are saying further research. All right. Selection A. Fantastic. Back over to you, Mike.
Great. Thanks, Chris. So in this part of the presentation, I'll be talking about how to actually implement strategies. It's my favorite part of the presentation. If you want to, if there's anything I don't cover completely, if you have any questions, put it in the chat. We'll make sure that we either get you answers at the end of this presentation, or we'll follow up with you later. But there's a whole bunch of strategies you can implement, and I've got a somewhat limited time. But this is, I'll talk about what you can do, and some of it is very impactful for clients, but it is really underutilized. Most people are not talking about these strategies. It can be a nice way to set yourself apart from the competition. And money, all money is emotional, but taxes, if you could save someone money on taxes in a way that they aren't expecting, that they think is smart, they will talk about it at cocktail parties. They'll remember it. So as I mentioned, it can be like a Swiss Army knife. I'll just jump into some of the solutions. We're going to talk about first the short-term benefits, then we'll talk about using the longer-term benefits. So what are you actually doing with that short-term deferral? You're moving the realization date of that capital gain, but you're not changing the character of the capital gain. So if it was long-term or short-term, that's not going to change, even if you don't trigger it for a few years down the line. It also, if the gain came from collectibles versus stock, that's not going to change. The character doesn't change. It's just the date. You're moving the date of when that is realized, and the order that you recognize capital gains and losses can really have a substantial effect on your tax bill. One good example of that is if you've got someone who's trading in the stock market, the market has a strong year, they have a strong year, they've got some substantial capital gains. They could certainly pay that capital gain. That would be the normal thing to do. But if they had a capital loss in a future year during the deferral period, what they could have done is deferred that original gain with a QOF. That would have moved the realization date of that gain. And then when they had the loss in the future year, they could have triggered that gain in the same year as the loss and wound up with a zero tax rate. So this is sort of a gridded explanation of it. So if you do the pay-as-you-go strategy, you wind up, which is typically what I think people do, they wind up with a tax loss carry forward. But if you use the QOF, you wind up owing zero in tax. Essentially, you either wind up with the tax loss carry forward or the cash. So you'd much rather have the cash. And even if you don't have a loss in the future, you wind up having kept your money working for you longer. So it's a really nice way to go if someone's in a market that has volatility and they're consistently in and out of. Another way to help is spreading out a capital gain. So if you've got a person who's selling a business and retiring, that last year they may have the income from running the business and also have a substantial capital gain from selling the company. But if they're retiring, they may have very low income years in the upcoming years. What you can do is defer the capital gain from selling the company with the QOF and trigger it in future years, selling a little bit of shares the next year's, a few more shares the next year, and spreading it out into whatever makes sense. And you're going to wind up with a lower overall tax rate. (1231) assets, again, they're business assets held for more than a year. 1231 assets are taxed asymmetrically, as we mentioned earlier. Capital gains are taxed at capital gain rates, but ordinary income or losses, 1231 losses, are taxed at ordinary income rates. So it's very favorable for the taxpayer. The one problem is there is a 5-year look back period. So if you have had a loss within 5 years of that gain, you're going to, instead of paying the capital gain rate, you're going to have to pay the ordinary income tax rate. So if you use the highest marginal rates, that's 85% higher tax rate, but you can use the QOF to drag that realization date of the capital gain outside of the 5-year look back window. And that's certainly a material difference. You just save the person 85% on their taxes versus a competitor who might have missed it. So it's a real tangible benefit. Getting into the longer side of the investment solutions, the benefit where if you hold the QOF you achieve the 10-year hold, you can now step up your cost basis 100%. And that winds up giving you a Roth-like return. It doesn't have the limitations of the annual contribution limits or the income limits that come along with Roths. Certainly with Roths, the government realized how much tax revenue they were giving up, and they've tried to restrict it. With QOFs, there's no dollar limit. If you've got a really large capital gain, you can make a really large investment that can potentially grow tax-free and enjoy compound growth out to 2047, as long as you make that 10-year hold. This is the compound growth chart. You'll see that the point I want to emphasize here is with all compound growth charts, they take off in the out years. So you do not want to get liquidated after 10 years. You want to stay in as long as you can. You want to do what's best for you. If you need the money, it's absolutely great to be able to take it and use it when you need it. But if you're lucky enough not to need the money and can let it go, it's a tremendous way to create wealth. And again, often it depends on what numbers you use, but 80-90% of the benefit comes after year 10. So you don't want to hold on for 10 years and then wind up getting liquidated just as you're really starting to get a lot of the wealth generating incentives kicking in. Intentionally defective grantor trusts, these are a staple of estate planning. They are defective in that it does not remove the asset from the trust isn't removed from you for income tax purposes, so you still have some control over it, but it is completely out of your estate for estate tax purposes. So it can freeze the asset in terms of estate tax liability. It protects the asset from nursing home claims or lawsuits. You might be a surgeon or in a high lawsuit profession. It is a tremendous way to protect assets and to make sure that they make it to the next generation. The problem is that because it's out of your estate, you don't get the step up on death. So you can wind up with a large capital gain liability being transferred to the next generation. But if you use a QOF, usually these have swapping powers. You can swap in a QOF. Your beneficiaries will step into your shoes in terms of holding period. And it's better than a step up on death, because once you make the 10-year hold, it's a step up whenever they sell it, 100% cost basis step up. So it makes the weakness of this very useful financial tool a strength if you pair it with a QOF. This I'd put into it's not a long-term or short-term, it's in the no choice category. Collectibles, people who trade in collectibles have had a tough go of it. They pay a higher marginal tax rate than most other assets of 28% versus 20% for the majority of assets. They also were able to 1031 their assets. So if you sold a painting, you could 1031 it when you bought the next painting. But the Tax Cuts and Jobs Act did away with that. It restricted 1031s basically to commercial real estate. So now you've got collectors who, in collectibles include art, wine, stamps, precious metals. They are stuck with this tax bill that they can't defer any other way other than QOFs. I shouldn't say any other way. You can set up trusts. There are other things you could potentially do. But the major way of deferring it would be the alternative to the 1031 would be the Qualified Opportunity Fund. So Qualified Opportunity Funds can defer the capital gain just with the capital gain amount being reinvested, and then you can reinvest the principal into collectibles. But they really gotten a tough deal. But one thing that does work for them is Qualified Opportunity Funds. Another solution is sometimes folks will find that they have cash, but it's not eligible, and they would like to make an investment in a Qualified Opportunity Fund, get the tax incentives, but they don't have a recent capital gain. One thing you can do, and this sort of illustrates how the QOFs work differently than the 1031 program, there's no cash tracing. So you can say this person has the cash, they want to make the QOF investment, they also have a highly appreciated stock. They could sell that stock, buy it right back. The wash sale rules wouldn't apply because you're harvesting a gain, not a loss. Now you've got that stock back to a market cost basis. You've removed the capital gain liability, and you can use that capital gain liability for the next 180 days to make that cash QOF eligible. So that's one way to make cash eligible. And Chris, we made it to question 4.
Yes, indeed, folks, we have made it. Polling question 4 is on your screens. Do you expect to make use of Opportunity Zone's tax incentives, as part of future financial planning? Make your selections now, folks, and of course, you have 60 seconds. You guys have 20 more seconds on this poll. Thank you to those who have answered so quickly on this one. Alrighty, folks, we're going to wind down polling question 4 of 4, and it looks like 50% of the attendees might are saying not sure, but 28% are saying yes. So back over to you.
Great. Thank you, Chris. So we're going to, in this section, compare and contrast 1031s, as I said before, they have been the way that people have deferred capital gains before the Tax Cuts and Jobs Act. These have been used for decades. They are now really restricted just to property, but you can use them at times alongside qualified opportunity funds. So we'll talk a little bit about that. Quickly, some of the differences. Typically, you have to, there are very rigid qualification requirements with 1031s. You need to hire someone to segregate the cash for you, a qualified intermediary. You also have to identify properties within 45 days and close on them within 180. You also, instead of with the QOF, you only have to invest the capital gain amount to defer the entire capital gain liability. With a 1031, you have to take the entire sales proceed and reinvest it to defer the entire capital gain liability. This chart, if you look at it sort of horizontally, you can see along the top, we sort of compare and contrast the two programs. So 1031s, it's only capital gains from commercial real estate, whereas OZs are from any source. You're required to invest all of the proceeds, whereas it's just the capital gain for QOFs. The 1031, the big advantage is you can defer indefinitely with a 1031. You can keep swapping properties. With a QOF, we're obviously hoping and expecting an extension, but as of right now, the deferral period ends right at the end of 2026. 1031s have strict cash tracing, which is why they have to have the qualified intermediaries. QOFs have no cash tracing. 45-day requirement is specific to the 1031, and there's no elimination of the tax, with the exception of the step up on death for 1031s, the swap to a drop strategy. With QOFs, you can eliminate all of the capital gains once you've achieved the 10-year hold. And as I've said many times, that goes all the way out to 2047. So that we'll give QOFs the benefit there, because you don't have to die to get the step up on death, step up on in basis. So this is a very general rule of thumb. Everybody's got specific situations, but how do you choose between the two of these? If you've got a situation where you've got high debt and a low cost basis, you're probably going to want to do a 1031. In this case, you're just moving the entire capital structure of the first property over to the second property. With a qualified opportunity fund, you've got a zero cost basis, so it's all capital gain. You'd have to invest the entire $10 million into this property to defer, into the QOF to defer the capital gain, and you'd still have to figure out what to do with the $5 million you still owe. So it's not a great situation. The flip side is true, however, when you've got a situation with low debt and a high cost basis. In this example, there's no debt, a $9 million cost basis. With a 1031, you'd still need to tie up $10 million to defer that capital gain. Whereas with a QOF, you'd only need to tie up $1 million, and the other $9 million would be completely unencumbered. Here it is in a sort of a graphical form, but again, very basic rule of thumb. That's the way you might want to think about that. That low debt, high cost basis QOF, and high debt, low cost basis, you want to look at a 1031. So QOFs can help in several different ways. When you have, you often get boot. If you're going into a smaller property, exchanging into a smaller property, some of the gain won't be covered, which is called boot. Sometimes some of the property being sold is not eligible to 1031. So that can also create another form of boot. And these are smaller remainder amounts, which you can invest. You can buy QOF stock and be able to defer the rest of that gain and make it fit a little bit better into your situation. But what happens probably most often are that the 1031 doesn't work out for some reason. Sometimes people will take money into their own possession, which you're not allowed to do with a QOF, or with a 1031 rather, but that does not eliminate you from doing a QOF. So we're often a backup plan for 1031s that either they can't identify the property within 45 days or they can't close within 180. Something goes wrong, that winds up being the QOF can wind up being a backup when you think that you're going to have to pay the tax. You can find that alternative through the QOF to defer the tax. Qualified intermediaries, when you use these, they will not give you the cash back until you hit either the 45 or the 180 day mark. One thing we were wondering, especially if they held it for 180 days, well, you've got 180 days to invest in a QOF. Can we change the money on the same day, or how do we do this? It turns out that if it goes into a new tax year, you can claim installment sale treatment. So using a qualified intermediary can help you to have a much longer investment period for of eligibility for a QOF. So if you claim the installment sale treatment, you not only can start a new 180 day period when you get the money back, but you could even aggregate it to year end and start it at December 31st. So sometimes you think you're in trouble and gonna have no options, but you still may. Key points. This is a broadly applicable. Almost any investor will have a capital gain over time. The QOF incentives can significantly increase after-tax return if they're used right. Stock ownership makes it much more accessible. I think most people think there are higher barriers to entry, and that's why more people haven't invested. But we look at this as Qualified Opportunity Fund 2.0, much easier for the consumer to get involved, and that was the goal of this fund, and I think we've done that. And control of the holding period is really key. You don't want to get liquidated because most of the benefits come after 10 years. And you don't want to have a situation where you can't take advantage of all these tax strategies. So being able to control your holding period is really essential. We've got a tax information page on our website, which I would highly encourage you to go to if you want to get involved with Qualified Opportunity Fund investing. All these forms are fairly simple. There's on our website, there's a whole bunch of further reading, including some articles I've either authored or co-authored. And with that, I think we are wrapped it up. I know I'm pretty close to time. Do we have any time for questions?
You may be able to get one question in before I wrap up. Go right ahead if you have something out there.
Let's start off with this question at least. Is there any difference between shares acquired through the subscription agreement versus those acquired on the open market?
They're identical. They're the same shares. They have the same benefits. So when you buy them either way, you're going to get a confirmation statement. That's going to start your 10-year clock. And the way it works is that when you sell to the next shareholder, that ends your deferment period or ends your benefit period for the Qualified Opportunity Fund purposes, and their 10-year clock starts on the shares that they bought either from you or from us. It's whenever you buy and whenever you sell the shares. That is how we keep track, and that's how the 10-year clock is kept.
Okay, folks, we are right at time. Mike, do you have any final words of wisdom for the group?
I just want to say thank you. Really appreciate it. I do think this webinar is incredibly well timed. There's been an upswell of interest since the election, and I think that's going to continue through 2025. I think we're all going to see a lot more questions and a lot more written about opportunity zones, and I'm looking forward to them becoming more mainstream in financial planning, and really appreciate the platform today and getting a chance to speak with so many people. And thank you very much for hosting, Chris.
Well, awesome, Mike. This has been fantastic. A lot of the attendees are saying thank you to you for a fantastic presentation. And we here at CPA Academy are going to wrap things up on our end. Folks, your credit will be processed today and will be available to you within approximately 24 hours. Check your inbox right now, folks. There's a full webinar evaluation that's waiting for you. There will be a full recording your account as well as all course materials. Thanks again to Mike Michael Kelley for coming in and giving us a fabulous presentation, as well as for Grace coming in and tackling some questions for us, and to you as attendees for speaking with us and getting your CPE with us, of course. We're looking forward to seeing everybody on future webinars, and please have a wonderful rest of your day. Thank you, folks. Take care.